Hello, and welcome back to the Safe, Simple Sound podcast. I'm your host, Alex. Here, our mission is to guide you toward financial freedom through strategies that are, you guessed it, safe, simple, and sound. Today, we are speaking directly to the accidental bookkeepers out there, the entrepreneurs who started a business to follow a passion, not to manage spreadsheets. We're drawing our insights today from a highly practical article titled The Business Checkbook Strategy. This piece is a fantastic resource for any DIY business owner looking to establish small business record-keeping discipline without needing an accounting degree. If you are ready to stop fearing tax season and start building a record-keeping system that actually works for you, you are in the right place. Let's dive in. Let's dive into what I like to call the Ironclad Rule of entrepreneurship. If you take nothing else away from today's episode, let it be this: separate business and personal finances. It sounds basic, right? But you would be shocked at how many brilliant business owners skip this step because they think they're too small to worry about it. Here's the reality. The single most critical step for any new entrepreneur is establishing a dedicated business checking account immediately. It doesn't matter if your revenue is $500 or $5 million. Why is this so urgent? Well, I want you to ask yourself, why is the psychological shift of having a separate business account just as important as the logistical benefits? Think about it. When you have a separate account, you stop treating your business revenue like extra cash in your pocket. You start treating it like business capital. It's a mindset shift. It tells your brain and the world that you are running a legitimate operation, not just a hobby. Now let's talk about the scary stuff for a second. The IRS. In the world of small business record keeping, commingling funds, that is, mixing your personal grocery money with your client payments, is a massive red flag for IRS audits. It's like painting a target on your back. How does maintaining separate accounts act as your first line of defense during an IRS examination? Simple. It provides IRS audit protection through clarity. If an auditor looks at your bank statement, they should see only business transactions. If they see a payment to a supplier right next to a purchase at a water park, they're going to question everything. Total separation provides clear evidence that your business is a business. Beyond protection, this is about sanity. A separate account simplifies tax preparation by automatically isolating business activity. Imagine trying to do your taxes and having to go through a year of personal bank statements, highlighting every coffee and trying to remember, was this for a client meeting or did I just need caffeine? When you separate, you get an accurate picture of financial health without personal spending clouding the view. It's like cleaning a dirty windshield. Suddenly, you can actually see where you're driving. Now, a practical tip on how to actually pay yourself, because yes, you should get paid. Proper owner compensation isn't about dipping into the till whenever you need to pay a personal bill. Do not pay your home mortgage directly from your business funds. Instead, write a physical check from the business account to your personal account. Or do a formal transfer. Move the money to your personal world first, then spend it. This keeps the lines crisp and clean. I want you to reflect on your current setup. When you swipe your card for a business expense, do you feel a moment of panic about which account it's coming from? That low-level anxiety drains your energy. Small business bookkeeping basics aren't just about math. They're about peace of mind. So, here's the takeaway. Treat your business entity with respect, and it will take care of you. Don't mix the streams. Here is your call to action for this segment. If you haven't already, make an appointment to open a business checking account this week. If you have one, review your last month's statement to ensure zero personal expenses were paid from it. Once you have that account open, you're holding a powerful tool. But a bank account is more than just a bucket for money. It's a data machine. Now, we're going to talk about how to turn that humble checkbook into a robust record-keeping system that practically does the accounting for you. Here's the great news for all the DIY entrepreneurs listening. You do not need expensive, complex accounting software the day you open your doors. You have a tool right in your pocket that can do the heavy lifting for you. Think of your checkbook register not just as a list of subtractions, but as a manual chart of accounts. Now, chart of accounts is just fancy accountant speak for buckets where your money goes. If you use your checkbook correctly, you are categorizing every single dollar without even touching a computer. But, and this is a big but, small business record keeping relies entirely on how you use one tiny line on that check, the memo line. Let's look at a real-world example. Say you run down to the local office supply store. You buy some printer paper, some ink, maybe a new stapler. If you write that check and just scribble office store in the memo line, or worse, leave it blank, you are setting yourself up for a headache. 6 months from now, you're going to stare at that entry and wonder, did I buy supplies? Or did I buy a new office chair? Or did I buy snacks for the break room? The IRS cares about that difference. To ensure IRS audit protection, you need specifics. So, take the 10 extra seconds. In the memo line, write office store, printer paper, and ink. Suddenly, that piece of paper isn't just a payment, it's proof. It's a valid tax deduction. You can take this a step further by mentally grouping your costs. You have your frequent flyers, things like materials, rent, or payroll. Then you have your one-offs. By being descriptive in your checkbook, you're essentially sorting these expenses into columns. When the end of the year rolls around, you aren't digging through a shoebox of faded receipts. You're just tallying up the descriptions you already wrote down. Now, I have to give you one major warning, a red flag to avoid at all costs. Stop writing checks to cash. I know, you're in a rush, you need $50 for supplies, and it's easy. But a check made out to cash is a financial dead end. It eliminates the paper trail. It doesn't prove who got the money or why they got it. If an examiner looks at that, they just see a withdrawal with no context. Always write the check to a specific person or business to keep your records legitimate. I want you to pause and reflect for a second. In our world of tap to pay and automatic subscriptions, how often do you actually look at what you spend? There is something powerful about a manual system. It forces you to slow down. When you have to physically write out the amount and the description, you become infinitely more mindful of your cash flow than you ever would be with a digital swipe. It connects you to the reality of your business finances. So let's put this into practice right now. Here is your call to action for today. I want you to pull out your check register or log into your bank view if you don't carry the book and review the last 30 days. Look for those vague entries. You know the ones: Amazon, Target, Venmo. While the memory is still fresh in your mind, annotate them. Write down exactly what you bought and why it was for the business. Future you is going to thank present you when tax season arrives. Now, once you have those records detailed and looking sharp, we have to make sure they match reality. Because what you think you have and what the bank says you have can be two very different numbers. But now we need to talk about what happens when the calendar flips. We're moving on to the monthly ritual, mastering bank reconciliation. Now, don't let the accounting jargon scare you off. I know, reconciliation sounds like something that requires a degree, but honestly, it's basically just a fancy way of making sure you and the bank agree on how much money you actually have. Think of it as a truth serum for your business finances. Reconciliation is the essential monthly process of verifying that the balance in your internal checkbook matches the bank's records. But here is the kicker, and this is where new entrepreneurs often get tripped up. Those two numbers almost never match perfectly on day one. Why? Because of timing differences. I want you to ask yourself a question. What are the risks of running your business based solely on the online balance you see on your banking app? We've all done it. You open the app, you see $5,000, and you think, great, I can afford that new equipment. But operating off that number is dangerous. That app is just a snapshot of cleared transactions. It doesn't know about the check you mailed to your landlord yesterday. To find your true balance, the process involves identifying two main things. First, deposits in transit. This is money you've received and recorded in your books. Maybe you deposited a client's check late on Friday afternoon, but the bank hasn't processed it yet. It's your money. It just hasn't arrived in the digital world. Second, and this is the big one, outstanding checks. These are payments you have sent, but the vendor hasn't cashed them yet. Think about how the concept of outstanding checks impacts your perception of your business's true liquidity. If you have $5,000 in the bank, but $4,000 in outstanding checks floating around in the mail, You don't have $5,000. You have $1,000. If you spend based on the bank's number, you're going to bounce checks. Balancing the books also requires adjusting your personal register for items found only on the bank statement. You might find a service fee you didn't expect, a tiny bit of interest earned, or, and this happens more than you think, recording errors. Maybe you wrote a check for $45, but accidentally wrote $54 in your register. This ritual catches those slips. Look, regular small business record keeping and reconciliation is the only way to catch bank errors, detect fraud early, and ensure you know exactly how much cash is actually available to spend. It stops you from flying blind. So here's your takeaway. Your business checking account isn't just a bucket of money, it's a flow of information, and you need to sync that flow every single month. Here is my challenge for you this week. I want you to locate the reconciliation worksheet. It's usually printed right on the back of your most recent bank statement, or you can download a simple template. Don't just glance at the statement and file it away. Sit down and complete a full reconciliation for the previous month. Find the difference between what the bank says you have and what you actually have. All right, so we've just tamed the beast that is your monthly bank reconciliation. We know the big numbers in the bank match the big numbers in your books. That feels good, right? But now I want to zoom in, way in. Because while the big numbers determine if you stay in business, it's often the tiny numbers that drive you crazy and cost you money you didn't even realize you were losing. We are moving on to plugging the leaks, petty cash, and small expenses. Now, I know what you're thinking. Alex, petty cash? That sounds like something from a 1950s office with a typewriter. But stick with me. In the world of small business record keeping, cash is still king for those tiny, annoying transactions. The problem is, without a system, those transactions are invisible. Here's the scenario. You're running out to a job site and you realize you forgot duct tape. You dash into the hardware store, pull a $10 bill out of your personal wallet, buy the tape, and shove the receipt in your pocket. 2 days later, that receipt is pulp in the washing machine. That $10 gone. The tax deduction gone. Small cash expenditures fall through the cracks of a business's finances constantly. It leads to messy records and, frankly, you paying more taxes than you owe because you're losing expenses. So let's fix it with a formal petty cash management system. It's incredibly simple, but you have to follow the rules. First, you need to establish the fund officially. Do not just take $20 from your pocket and put it in a jar. You need to write a physical check from your business checking account. Make it out to petty cash. Let's pick a fixed amount, say $50. Go to the bank, cash that check, and put the money in a secure lockbox or a dedicated heavy-duty envelope. Now you have a $50 float. Here's the discipline part. Accountants call this the impressed system. Think of it like a balance scale. The rule is, the cash in the box plus the receipts in the box must always equal the original fixed amount. So if you take $10 out to buy stamps, a receipt for $10 goes back in. $40 cash plus $10 receipt, $50. If you buy donuts for a client for $15, the receipt goes in. $25 cash, $25 in receipts, ink $50. See how that works? It keeps you honest. Eventually, the cash runs low. Maybe you're down to your last $5. This is the moment of truth. You do not just throw in random cash. You gather up all those little receipts from the box, the stamps, the donuts, the duct tape. Let's say they total $45. You write a new business check for exactly $45, the total of the receipts, and cash it to replenish the box back to the original $50. And here is the magic trick. You take those receipts you just removed and you record them into your chart of accounts or your main ledger. That is the moment those invisible cash purchases officially become tax-deductible business expenses. I want you to take a second and ask yourself, how much money did you lose last year? How much did you pay in unnecessary taxes because you paid for small items with personal cash and lost the paper trail? $100? $500? And deeper than that, why is this discipline so important? Why bother with the receipt plus cash equals total formula? It's because it builds financial integrity. If you can be trusted to manage the pennies perfectly, you'll be much better equipped to manage the thousands. So let's stop the leaking. Here's your call to action for this segment. I want you to go purchase a small lockbox or even just grab a dedicated envelope. Write a $50 check to petty cash and officially set up your small expense fund today. Stop reaching into your own pocket to fund your business. And that wraps up our deep dive into the Business Checkbook Strategy. We've covered a lot of ground today, moving from the panic of tax season to the confidence of a structured system. We learned that effective small business record keeping doesn't require expensive software. It requires discipline. By sticking to the Ironclad Rule and maintaining a dedicated business checking account, you are building the first line of defense for audit protection. I hope you really took to heart our discussion on bank reconciliation. It's easy to trust the number on your banking app, but as we discussed, taking the time to balance your own books is the only way to truly understand your cash flow. And for those of you tired of losing receipts, implementing that petty cash management system we talked about is going to be a game changer for capturing every single deduction you deserve. Thank you so much for spending part of your day with me. To all the accidental bookkeepers out there, you've got this. If you want to review the steps we discussed today, head over to the show notes. We've linked the reference article and a simple checklist to help you get started. If you found value in this episode, please subscribe and leave us a review. It really helps us reach more entrepreneurs just like you. Until then, keep your records clean, keep your accounts separate, and remember, the best financial path is always safe, simple, and sound. This is Alex, signing off.